Okay, it's Patrick. Do you know what time of month it is?
It's time for Tony's macro little window.
That's right, our favorite technical navigator, the author of the Morning Navigator newsletter, is joining us today, and we're going to talk all things macro. Tony, thanks for being on with us.
Thanks for having me again, man. You guys are the best up north. How's it going?
Good, good.
Yeah.
So it's an exciting time in the markets. We're taping this Friday. We're going to see some action with the trade deal. But I think that one of the things that you wanted to talk about is first up is interest rates, and a subject near and dear to my heart because I think you're erring on the bear side.
Well, yeah, at the moment, I think that we're due for a pullback in the bond market. I think yields can trade higher. And I feel like we're getting price confirmation right before our eyes. Those two green dates that I have circled back there, those were two events that happened after, as you can see in the month of August, with yields plummeting after the negative yielding rate vortex took over the world for the month of August. There were two bullish bond data points in September that yielded opposite results. Right on September 3rd, we got that big US ISM manufacturing that tips into negative territory, and that was a massively bullish bond, print. And bonds did not advance at all. They made a new low in yield, so they made a new high. Bonds made a new high for the move, and then backed off and settled in positive territory, but back in the range. And then you had another date on September 12th when Mario Draghi came out and went, batshit, dovish. That was a bullish moment for the bond market, and the bond market continued to pull back. In fact, after the Draghi bullish bond announcement, 10-year yields went, flying through 50-day moving average and said to me that, like, this move is for real. So we kind of surfed it on the way back. And then I anticipated a pullback, and I kind of wrote about it right on the money that we would make a higher low in yields. And that's what we've done. And so now we're coming out with some, economic data that seems to be, relatively plausible in terms of, building a case against a recession coming out. And, like you would expect, an overextended, fully sentiment, gung-ho, bullish, long bond market is going to pull back. So I feel like that's what we're seeing now, and it's going to feed into a whole bunch of other trades. I think the S&P bobbles. I think gold gives us a chance to buy it. And so we'll go over things like that. But you guys take the lead from here. That's my spiel on the 10-year yield.
So
Tony, you're going to get cut off from Patrick. You're talking bond bearishness.
No. But listen. All right. Don't put
I'm a
words in
slave
my
to
mouth
price
here.
action. I'm a slave to price
Listen,
action.
I'm a price action guy too. What I actually wanted to ask you though is do you have a bias in terms of the way the yield curve develops from here? Because to me, we didn't see this much of a response on the 2-year relative, which has created a little bit of a steepening. I mean, is this more of a narrative for you on the longer end of the curve that we're going to have like the yields back up and the 2-year holds in, or do you think this like all bonds here doesn't matter on what duration are all backing up?
No, Patrick, the curve obviously is critical, right? The curve is obviously critical. And, my harbinger, if I may use that word, the 3-month 10-year spread, which was the first one to sound the alarm into negative territory, right?
Right.
That was the first one that went negative. It dipped negative in March of this year. And then, man, that's a great chart to look at if you can pull it up. And
Oh yeah, right. I have it right here, so you can see
holy smokes. Dude, hell yeah.
That's quite the little breakout there for a technician, isn't it?
As we speak now, this yield is pulling back into positive territory, right?
Yeah.
So now, therefore, rejecting the move into negative territory, that is preaching what? Recession. So this is the first sign that I see that is about to literally knock the knees out from under the media. When we start reporting on this, and meaning we, the unconflicted newsletter writers, and then it makes its way around FinTwit, about how this move is leading the way now. You know what I mean? So I'm getting confident that this is a change in direction in interest rates that corresponds with a, large magnitude move across a major boundary in this 3-month 10-year spread, closing it back into positive territory now for the first time since August. So
Yeah.
this is the kind of thing that changes markets around. It looks like stocks are liking it, and precious metals are backing off a touch, as you would expect with higher yields. But the market is definitely speaking to us on this close today.
So
Patrick, this is like Bond audio bear porn.
Yeah.
so
That's
Kev,
great.
what's your take though? I mean, is the steepener on now?
Oh, the steepener's on. It's going to be the trade of the decade. The
The
steepener.
decade.
And,
But you think that this is it? Like that?
do I think this is it? I don't know. I definitely think the long end is in a lot of trouble, and I think the short end is going to be pinned by Powell because I don't see him getting at all hawkish anytime soon. So I think that the long end's acting poorly, and that so we're getting.
So you think the bear steepener is going to be the driver, right?
Yeah, I think that the long bond's going to be in trouble. I agree with Tony. It's trading like shit. It's heavy
Yeah.
and it looks bad. And I would contend it's even traded badly, even in the face of economic weak numbers in the U.S.
Yeah.
I think it actually has a lot to do with Japan's decision to steepen their yield curve, and that most of the action that we see in the last 2 weeks where bonds have really backed up. I think it started with Japan. And
Yeah.
I think that we're realizing that central banks are waking up to the idea that a flat yield curve at negative levels is stupid and it hurts your economy. And that it also combine that with the idea that maybe we're going to get some fiscal. It makes all sorts of sense to get out sell the long end of the curve.
So do either of you have an opinion then on what does this also make it pretty bearish for the investment grade corporates?
Well, I'll let
Like
Tony.
just as the correlation, right? Like
Over my head.
Okay, well, I'll give it a whirl. Of course, the investment grade corporates will go down if bonds go down, but the question is, will spreads tighten or widen during that period? I'm of the opinion that it's probably just it's nothing. Like it's not gonna be some sort of liquidity event that causes a blowout like 2008. It's just that as rates chug higher, that those things are gonna have trouble outperforming. And if anything, though, I think that I could see a situation where treasuries, which I think are vastly overowned, the people go into corporates even a little bit more. So I don't think spreads.
You think so, eh?
Yeah, I don't think spreads get in any real trouble.
I just don't agree with you, but whatever.
I know, but that's what makes a market. Tony,
Yeah.
one of the things that I believe that interest rates affect gold, because gold at the end of the day is nobody's liability and often trades like a zero coupon bond, in my opinion. I was wondering what you thought with this backup in rates, what that means for gold, and you are famous for your gold calls. Just unbelievable gold calls. So people want to know, inquiring minds want to know what you think about gold going forward.
Well, Kevin, thank you very much. First of all, I have to just say thank you for the compliment. It's too kind of you to say that. I was taught by the best gold traders, and I will say some of the, literally the best gold traders in the world. Some I can mention, some I can't, but Guy Adami is one of them. And the people that I learned from have been pretty consistent with their views and their methodologies, and we've been in touch over the years. So we're just following this really closely. I'm looking for gold basically to pull back to the 100-day moving average at 1450, where I'm going to buy the snot out of it the first time down and sell it again on a bounce. And then I think it's going to be supported even better down at 1350, 1370, which is down at the real breakout level. And I think by the time it grinds down there, timing wise, that this, pullback in the bond market will, have found a level, maybe not be done, maybe not exhausted itself, but have found a level, and then we'll see what happens. Right. But it just sort of makes sense to me with the 30,000 foot up, machinations of the relationship between gold and interest rates that, while we're witnessing what I'm calling and Kevin thinks is definitely, a turning event in the curve, steepening and in yields rising, that we should expect something dramatic to happen, counter in the gold markets, which have been driven by this whole entire move. So, I'm going to be here on the bid to buy gold. And, I think that's the way that you trade it. I think we're in a secular gold breakout still. And I don't think we'll see it back below 1350 for a while to come. I could be crazy. But I'm calling it like I see it. That's where I am. Silver still
So
looks good to me, and that's where we are. Go ahead.
all right, so my question then is this. All right, so we've had a period up until for the last many months that was basically a risk on, risk off, and during the risk off period, bonds and gold were moving very well, and other risk assets were struggling. And so, what I now just heard from both of you to one degree or another. Actually, I don't know about your opinion on gold there, Kev, but bonds pull back and subsequently gold retraces. And we're not talking a big reversal trend, but just a backfilling of this prior breakout. Maybe we see 1400, maybe we see 1350, but it backs up. So does that mean risk on assets are game on? Like, if these kind of like gold and bonds are pulling back, are we seeing the stock market going to be the benefactor of all this?
I think it's certain, it could be, but I don't know if the stock market has been necessarily driven by as much by this. I think this scenario is a green light go for the stock market, and that the stock market is probably being held back by this trade rhetoric at some level, and at some other level by the fact that some of its biggest constituents have stopped performing. So, there's a whole lot of other factors to me involved in the stock market. You've got the private equity overlay, and you've got so many other overlays, the IPO story overlay, and all of this that can affect the stock market that may not have as much of an effect on the bond market if I'm seeing it correctly, which may not necessarily be the case.
So, Patrick, I would contend that it might be risk on, but it might be that risk on becomes a different shape than it has in the past, and that you might see things like emerging markets or even Europe. I know you're going to hate that idea, Patrick, but
no, you know what? I mean, that's in the top five, right? Like
but they're going to start outperforming, and so I don't think that you necessarily have to have risk on equals S&P headed higher. There will reach a point where it's all baked in, but so what do you think, Tony? Let's talk currencies a little bit. What do you think of the dollar in here? Like, do you think that was a classic prairie dog that's going to be there was a breakout up above 99.60 there, or it tried to break out and it's now back into the range, and are we headed lower?
Well, I feel like I'm happily still on the outside of the dollar street fight looking in. Don't see the dollar as being a threat to any of the other positions really that I'm trading on my macro risk parameters. The dollar to me is safely and properly gliding higher as the best option amongst the dumpster fire around it. And I think it's just going to stay that way. I'm definitely in the dollar milkshake camp at some level. I understand the shortage of them is definitely going to be a component in, the whole entire complexities of the repo market and the dollar strength behind it. So I'm not giving up. That's like one of my secular views in my matrix is that I'm a dollar bull, and I'm not.
Patrick, I'm gonna preempt you here because I was just looking through Tony's note, and I noticed that he is also not only is he an extremely smart guy when it comes to bonds. But he's also a pretty good guy when it comes to pound trading.
Oh boy! So
what, Tony? What do you think of the pound?
Other than the market gods are shaming me for making a bet with you, Kevin, about this pound trade.
Yeah.
But
so what do you think, Tony? What are you looking at?
This has been the catalyst, right? But yeah.
All I'm looking at is price action as usual, man. The day that it broke back above the 50-day moving average, those huge magnitude moves told me that it was on the move. The thing is trading like a technical wet dream from moving average to moving average, while the whole entire FX complex that I speak to is doom and gloom, doom and gloom, doom and gloom, to the point that I'm in a chat room with a couple of guys like that. And they express their bearishness on every single dip, every time something goes wrong with Boris. And I say, yeah, okay, but it's not making a new low below 120, is it? And then finally, this week we get the extension that you expect when people are short pounds. And so now the beauty is that we are we're right on the 200-day moving average, which is going to trigger a whole bunch more buying stops in the pound if we get a close above there. And I feel like that's the low-hanging fruit. And the direction certainly that, traffic will be going and will put the most people in pain. So I think higher for the pound. I still think we retrace toward 130 and then we'll see. But I do expect that this is the explosive move that busted through the 200-day moving average. I wish it was something that was easier to play and, more liquid and that we could bash around a little bit more. But you can get pound exposure.
All right. Well, you know what, Kev? So you still think we're going to hit 129 and you cash in your bet?
Oh, yeah, Patrick, you're going to – well, I shouldn't say anything.
Yeah.
Come on, I'm trying to goat you into.
Yeah, no. I respectfully understand that.
Out?
Sorry, what's that?
If you want, Kev, we'll buy Patrick out or something like that. I mean,
That's right. We should be offering him the ability to early settlement. No.
Dangle 80 cents on the dollar.
Yeah, no.
Because the bragging rights are just too great.
That's right.
It's not
like I want to see how many of these things I win or lose.
Hey Kev, can I ask you a question while I've got you here? As you mentioned a dirty word in TG Macro headquarters before, and that is the infinite dunce Jerome Powell at the head of our Federal Reserve down here, and I was wondering what you thought about this new operation. That looks a lot like QE and smells a lot like QE. That's not QE. Can you comment on that, please?
So, first of all, if anybody tells you they truly understand it, they're probably lying, because the reality is there's a lot of moving parts to this, and we've hit this. We changed the environment coming out of the great financial crisis. We changed the way that the monetary system works, and there's no doubt that the Fed used to be in the market all the time, buying and selling T-bills to keep the rate where it was. And then what happened was, once there was plentiful of reserves, they didn't have to do that anymore. They could just basically set it. And then what happened was they made a mistake. And I think what's one of the interesting things is they tried to downplay their mistake and say that it wasn't that big a deal. I think that if you got them in private, they would say they weren't ready for it and it caught them off guard. They weren't expecting it at this point. And I think that they've done the correct thing going forward in terms of fixing the issue, but I'm still nervous about it, Tony. I'm nervous because at the end of the day, they still needed liquidity. There was still a requirement for more liquidity, and I'm also nervous. I go back to that Jim Bianco chart that I love talking about, which shows the Federal Reserve's policy rate versus the rest of the world. The Federal Reserve still has the highest policy rate in the world, and these are when mistakes happen. So I hear lots of excuses of why this doesn't matter. I understand them. I am happy that they're on top of it. I just worry that the next one is also going to catch them off guard, and if they're not ready there with the liquidity that the system needs, then it could be a situation where there is a little bit of a hiccup. So I don't really have anything insightful to say except that it makes me a little nervous. Then I'm also worried about the fact that we needed to do it and that nobody really knows why we needed to do it and why it continues even past the tax settlement date.
Yep.
All right. So that's kind of my 2 cents. I do believe that what we really need is the U.S. to have a lower rate than the rest of not than the rest of the world, but to not be the highest rate in the world. And that is ultimately, you might not like it. The American central bank might not like being the central bank to the world, but the reality is with the reserve currency, that is the truth of the matter is that they are the reserve currency. And as long as that continues, I worry anytime I see there's a liquidity shortage and a dollar shortage. Now, I will say one thing. I'm kind of happy that the dollar is going down, and that is ultimately one of the things, the kind of guideposts that I will watch. And if you did see a situation where there was a liquidity crunch and the dollar was skyrocketing again, that's what would make me really nervous about kind of risk assets.
Right.
Excellent point. Yeah,
So,
that's a good point.
Tony, I want to move
Yep.
on though, because
Let's move on.
from the time though when you were last on, we had this big oil spike from that attack in Saudi Arabia, and
Yeah.
then a monstrous nosedive all the way back down to multi-month lows. And
Yeah.
what the hell's going on in your mind in oil? Is this going to be a short-term low at this technical support? Because Kevin's going to say there's no such thing as a triple bottom. But what's your thinking here?
I think that oil likes the price of $55 is what I think, right? This disruption is wildly interesting, especially since they're getting diminishing returns on bigger disruptions. You know what I mean? Like we got a $2 bounce, a $3 bounce and back after an attack on the biggest production facility in the world. I would have assumed that it could have gotten a lot hairier than that. In fact, I have to say the bad with the good. I bought USO and lost 50 cents on it in that episode, which is something that I would do time and again, because a lot of times oil will surprise you. You'll literally get sticker shock from the price of oil when things like that go on. And I would place that bet over and over again, given my experience with oil, but it didn't work out and I got out. So the market came down and everybody was expecting this implosion through 50, which I'm still absolutely not expecting. I don't think the market is backwardated enough to attract many longs. And I don't think that, hold on a second. Yeah. I don't think that the market is long enough to backwardated enough to attract many longs. And so a spill through 50 might be, kind of anticlimactic. It might be a little bit of a dry heave down there where there's a little bit of support all the way down, and then next thing you know, we're right back at 55 with one headline out of Saudi Arabia. Because I get a feeling that that's going to I just have a feeling that that's going to persist. I mean, who the hell knows it? Like Kevin says, if you say you know something about what's going to come out of Saudi Arabia, you're full of beans, like it is a total random headline generator. But
basically, this is not the right time to be going heavy into oil.
I think I agree. I don't think it's time to bet on a short trade at all. I'm like, I expect volatility, but I don't expect trending. So I'm not really, I thought that there would have been a bigger upside move after the Abcake incident. And so I don't think that it's going anywhere. I think it's limited to it likes the prices of 55. So that's what I think.
Patrick, I will say one thing. I am a oil bull. I just pulled up the chart, and it terrifies me because you're absolutely correct. It looks like it's trying to make a triple bottom, which, according to my voodoo magic, doesn't exist. So therefore, I have to think that it's going lower. Even though I'm like a huge bull. No, I don't actually think that, Patrick. I'm gonna be long and assuming that it's like a unicorn. It's going to be like a leprechaun. This will be the one triple bottom that works, buddy. This will be it, and then it'll be like we'll paste this one. Look, there's a triple bottom that actually worked.
So
right.
So
first of all, put it in the Smithsonian.
So in my mind, it was incredibly oversold, and a reaction to like 55, 57 is a very natural retracement of a very oversold condition. But to me, the big tell isn't been given yet. It's about how it behaves when it starts to sell again. And if the buyers are holding the line during little consolidations back down, that could be a major bottom. But I don't want to make a big call. I think we'll see 56, 57 temporarily. It'll probably back off of there, and then it's how the bulls behave during that turn that's going to be the big tell. And so it'll be interesting to watch.
Okay, so Tony, we've talked about a few things. Why don't you leave us with one technically bearish stock that you don't like?
Netflix.
Okay.
All right. Let's take
if you want. A lot of it is based on technicals and now a retracement, but I get a feeling that this time around it is, limited to big picture speaking. I was going to say like 335, 340 on the upside, but I don't think it even gets that high. I think it's in the
but you're not shorting yet then. You're basically...
I have a bearish view on my view matrix, and I have not put a physical position on myself yet. But I think that if you
Right.
get to sell it anywhere near 300, which is now, that you can sell that stock as it continues to underperform FANG, as the competition creeps up. To me, this just looks like every single other company that came out with a brilliant invention had its model ripped off by the heavyweights on the block, namely Disney, Apple, and everybody else that's going to be in the streaming business like Hulu, et cetera. And now they've got competition everywhere
Yeah.
you look. So until they, it's going to take them a while to adjust like that, right? But Starbucks didn't perform for, probably 5 years while the S&P rocketed, and Ackman stepped in to fix the problem. But I feel like this is another scenario like that where Netflix is going to break down / underperform as the big guys on the block come in and undercut them on price and wider distribution and everything else.
Well, that's great.
I love your levels, Tone, because that's exactly what I was thinking. I don't think we're going to see us trade back to 370, 380. So any pop to 320 to 340 on the upside is probably going to be a great place to fade it and put on some fresh new shorts. So let's see whether Netflix does that.
Well, Tony, thanks
Subscriber
for
growth.
joining us. Oh, sorry.
Yes.
You know what? We're running a little short of time, Tony. So what we're going to do here, why don't you give everyone, tell them where they can find you, what your Twitter handle is, what they can sign up for your newsletter. And I highly suggest everyone sign up for the free edition of Tony's newsletter. And if you like it, think about buying it on a more regular basis. But why don't you give everyone your coordinates?
Absolutely, man. www.tgmacro.com is where you can find me, my services, referrals, testimonials. You can sign up for a trial of my newsletter. And, hopefully people will feel the same as you, Kev. I can't thank you enough for being so supportive of my work and being such a good client of my firm.
Well, it's great. Thanks for being on, Tony. We really appreciate it. And for those who want more, Tony, make sure you stick around for the after hours. We're getting Tony for the full, usually we only get him for 20 minutes, but we're getting him for the full guest show this time. So stick around in the after hours.